Good afternoon, folks. Welcome to our regular Wednesday lunchtime webinar. We're just going to leave the doors open, so to speak, for another minute or so to let folks come in before we kick off on this beautiful Friday afternoon. I'm sure the sun is shining where you are. I'm looking forward to going down to Taunton later on for the cricket. So happy days. We'll just leave the doors open for another. What is the time now? Just about a minute past.
Yeah, just a minute past.
So we'll give it another 60 seconds, and then we'll kick in. Excellent. Just let the clock tick round.
I think they're fighting the weather for attendance today, Andrew.
Yes, I think that's probably
beaches were being bagged at 6 o'clock this morning, apparently.
Well, I listened to the news this morning in a little drive out, and the advice was that you should stay in between 11 o'clock and 3 o'clock. So we're following sensible advice.
Yes, you could always watch it from your garden as well.
That's true.
We're sensible people.
Anyway, as soon as that clicks round to 2 minutes past, I'm going to make a start, I think. Yeah, here we go. So officially, good afternoon, ladies and gents. My name is Andrew Carpenter. I'm Chief Executive of the Structural Timber Association and also CE in the Southwest and the Midlands. And I'm joined in hosting this webinar by the rest of my CE family. You'll see the logos around the screen and also the CIOB. So lots of groups bringing you these valuable Friday sessions now. Delighted today that we're joined by Alan Wilen. Alan I've known for a number of years from Glenigan, and Glenigan have worked with CE over a number of years to provide KPIs for the sector. We thought that one of the hot potatoes at the moment was the economy and the state of the economy, and so we thought a little look at market activity wouldn't go amiss. So Alan, thank you for agreeing to do this.
That's all right.
At very short notice. We've got no survey for you to kick off with today, but what we have got is, as always, the Slido. So if you could go to slido.com with today's code hashtag LM170622 and pose any questions in Slido as Alan speaks. And then at the end of the presentation, we will go to a Q&A session and Alan can go through the questions and make the answers as appropriate. So I think, Alan, probably without further ado, I will mute myself and turn my camera off and offer the floor to you, sir.
All right. Thank you very much. Thank you, Andrew. I shall just share my screen here, and hopefully we can kick off. I thought what perhaps is a useful introduction. The first caveat I would make is we're currently in forecasting mode as we speak at Glenigan. We produce forecasts twice a year, and we're just working on our sort of summer forecast at the moment, which will be out in the next few weeks. So whilst the forecast itself is not ready yet, I will certainly sort of comment on the data, having sort of been going through the forecast information as we go through. So hopefully that will give you some useful pointers and updates on where we see things going. But in terms of the actual figures, I'm going to refer back to the formal forecast we published in last November, and really just comment on how things have moved on since then, and because a lot has changed, as you're all too aware. Perhaps just first to kick off though, and to comment that and explain a little bit about Glenigan. I'm the economics director at Glenigan. Glenigan itself is a construction data company. We track all construction projects that are being planned and taken forward in the UK, and now covering the Republic of Ireland as well. And we're part of a wider European group who do similar analysis and project information across Europe, called Big Factor, which is a Swedish company originally. Effectively, most of the information we gather is primarily used as a a sales lead tool by our subscribers who try to find business opportunities and projects they can get involved with in one form or another, whether that's as a material provider or as a contractor or subcontractor. But I tend to use this data perhaps in a more strategic role, look at where the trends are coming forward, and obviously helping that to give a prediction as to where we see the market moving over the next couple of years. We produce a forecast for the value of what we call underlying projects that are starting on sites. This is the value of work that's actually getting underway on a project by project basis, but looking at it as sort of a global or sector level for the UK. We produced our last formal forecast was published in November, and you can see then we saw a sort of sharp fall away in the value of work that was starting on site during the course of last year, after an incredibly strong bounce back in the first quarter. There was a lot of pent up activity that contractors and clients were keen to get onto site as quickly as possible, as the sort of restraints from COVID were eased at the beginning of last year. Obviously, there were still some restrictions that were in place during the course of last year, but people were trying to progress projects nevertheless during the course of that year. But we did see a fall away, and what we've also seen is a shift in activity across different sectors and parts of the country. And certainly, we anticipate that shift and change is likely to play out further over the next couple of years. So I will come back to those as we look into individual sectors in a little bit more detail in a moment. Clearly, obviously, the big issues that perhaps are behind that drop off in activity in terms of projects starting on site last year, particularly towards the end of last year, I think materials availability and cost was one of the big issues that was already at play there. And we've seen further developments there over the first quarter of this year and going into the second due to the war in Ukraine, which is further exacerbating issues, and certainly something we anticipate was going to be a sort of an additional break on both the wider economy, but also directly on construction activity over the course of 2022. Perhaps if you first of all look at the overall pattern of activity, you can see this is the value of projects that are starting on site on the left and detailed planning approvals on the right. I think the detailed projects that are securing detailed planning approvals is a really useful lead indicator of what's subsequently going to be coming forward to start on site. And I think the interesting thing from this is you can see from...
Excuse me, Alan.
Yes, certainly.
We're not seeing anything on the screen. Are you meant to be sharing what you're talking about?
I certainly hope so.
Okay.
Let me just try again. Now, can you see something?
Yes, thanks very much.
Okay, that's very strange. Okay. Glad someone commented. Okay. Yeah, so in terms of projects starting on site, as you can see that during the course of 2021, there was a sort of a tail off in underlying projects starting on site, and we also saw during the course of last year what we call major projects over 100 million on top of the underlying market, where we see it was a big boost, and that has again tailed off a little bit in recent months, really because obviously last year we saw some really big schemes really starting to get up, such as HS2, which helped to bolster activity there. There was also some major wind farm projects. If you move over to the development pipeline side, the detailed planning approvals, I think the interesting thing there is actually it's perhaps a bit more stable, more positive picture. During COVID, there was a continued increase in the value of work that was securing planning approval. So there's a strong pipeline of projects that can move forward if the industry confidence and client confidence is there to take them forward. And actually, it sort of picked up again in terms of the underlying picture in recent months as well. So it's both in terms of the number, which I've got on there as a number of projects, which is the line, but also the value of work that's coming forward. So potentially a really positive picture, but I think a lot of it's going to rely on confidence and the ability for people to take those projects forward. And I think that's going to be the big issue over the next few years. Again, similarly, if you look at the wider picture, we do it in our monthly snapshot of activity. You can see that during the course of last year, there was a falling away in underlying projects starting on site. We seasonally adjust those, so it gives a clearer picture of what can be quite a volatile month-by-month picture. And what we've seen really during the course of this year is a bit of stabilization coming in, actually, after the declines we saw last year. One of the things that I think is quite useful, really, to have a look at the pattern of activity there is some of the data that we've got for a trade survey we do for the National Federation of Roofing Contractors. We do this on a quarterly basis, and clearly over the last year or so has been a strong growth in activity that they've experienced, both in team workload and new inquiries, and still positive going forward, and their expectations for the next 12 months are still positive. But having said that, they're also contending, as I think perhaps all sectors are, with some significant cost pressures. And it's quite significant when you look. One of the questions we ask, have you seen an increase in costs over the last year or last quarter? And really practically everyone has seen a significant increase in costs over those two periods. And you can see why from some official data. The chart there on the right is the official government statistics on building material costs and inflation, and they put together a basket index, a bit like for the consumer price index. They do one for material prices and various categories of materials, and you can see that actually there's a fantastically sharp increase in inflationary pressures last year. In January, overall prices were 21% up on a year earlier, and obviously in some material categories it was much sharper than that. I think structural steel, for example, was up 55% in that period, and then obviously subsequently British Steel and others have increased their prices further. So there's some real cost pressures coming forward for that the industry's got to contend with, both from a contracting perspective but also from a client perspective potentially. And then there's been the whole availability issue as well, which I think is interestingly that still is an issue, and you can see that again in the materials, the survey from for the NFRC, really for the NFRC, that they say, we are, the simple question, is availability getting better or worse? And we also ask about particular materials as categories as well. And you can see that it's generally got worse, but I think encouragingly, it does seem to be stabilizing a little bit. The proportion it's saying it's getting worse in the last quarter compared to the previous one has fallen away from complete widespread, almost 100% in the second quarter of last year to just over a quarter on balance in the final, the latest quarter we did for the first quarter of this year. We're just about to undertake the next second quarter survey now. And again, you can see the issue there in terms of availability. I think this was quite interesting. It's perhaps a little bit away from the timber side of things, and I think it's interesting. But it's I think from the construction perspective, it's how all the various elements fit together, and you can certainly see that actually production and deliveries, both in terms of ready-mix concrete and particularly concrete roof tiles, had been lagging, still being significantly below the levels, pre-pandemic levels. So it really was a sort of a lack of production that was exacerbating those shortages during the course of last year. Now, I think that shortage of materials does seem to be, it's got a number of potential impacts. I mean, one of the first things is it going to mean that projects get delayed or put on hold as a result of that? Now, one of the things we do is we sort of do a sort of, when our researchers are chasing up and finding out how a project's going, also we record if a project is sort of formally put on hold, so to speak. And we haven't really seen a big increase in that. If anything, it's still running sort of below pre-pandemic levels. Obviously, during the actual initial lockdown period, there's quite a spike in the number of projects that were being put on hold, but that was relatively short-lived. And I think so. I think it's. And if you look at the various stages as well, in terms of they were put on hold, again, there's no particular sort of message there, and in saying actually it's the projects aren't going out to tender or anything like that. So it's not that. I think that's perhaps the issue. But one of the things we did look at is not so much that, but when how long is it taking projects to they're still in progress, but how long is it taking them to progress from one stage to finally get onto site and then to be completed? And what we have really seen particularly since 2019, but certainly on if you're looking at the projects that are sort of progressing during the course of this year, there's been quite a stretching out of lead times, whether it's the time taken from detailed consent to contract being awarded, or even from start on site to completion. Those periods have extended. Now, some of that may relate directly back to projects that were caught up during the pandemic itself back in 2020, and that could have been a contributing factor. But also, I think the whole issue of materials availability and cost suggests that actually, yes, projects are progressing, but there's a lot of additional work, perhaps revisiting a project to look at the design side of things. So that's effectively, and also then perhaps actually just sort of once you are on site, actually having the material availability to progress things taking longer. I think all of those factors are perhaps sort of dragging out the construction process, and clearly that's got implications for anyone who's operating in that sector in terms of actually, if you think you've got a contract that's going to call on your services or materials at a set time, but that can be something of a sort of mobile feast from that perspective, which obviously generates a lot of challenges. So from that perspective, how's that likely to impact things as we go forward over the next few years? So I'm going to go run now through the various sectors we've got and really how they're likely to play out. Starting with the housing side of things, which if you look at the house price forecast from Savills, for example, clearly there's an expectation of over the next 5 years of a regional shift there, with I guess a north-south divide, but actually the growth being in the northern half of the UK rather than London and the southeast, and that does seem to be playing out at the moment, and having implications perhaps for construction activity. The other factor that perhaps is at work here has been the build-to-rent sector, which fell back very sharply prior to the pandemic, and fell back further during the pandemic, but has bounced back quite strongly over the last last year, 12 months or so. As you can see, there's a strong pipeline of projects, and obviously a lot of those tend to be high-rise projects in urban areas. But actually, it's interesting. There's a number of more family housing related projects. There's a couple of those within the pipeline away from the major urban areas, where perhaps a number of investors are actually looking at getting into that sector. It's obviously a small element within the private housing sector at the moment, but I think it is a fast growing one again. I think the main thing that's going to be dominating the sector is the traditional build for home ownership element. And I think there, as you can see from the chart on the right there, the planning approvals, the pipeline there is strong. There's a lot of projects that have already secured planning approval. I think the latest first quarter of this year, it did soften a little bit in terms of more projects that are securing approval, but I think that really reflects the fact there's a strong pipeline of projects already there that can move forward if the confidence is there. We did see quite a strong bounce back in project starts last year. I think now, given the more difficult economic situation, increasingly difficult economic situation facing a lot of households, I think that's going to temper the pace of growth this year. In fact, I think we're looking at potentially a weakening in private project starts during the course of this year. Sort of pretty flat picture, but obviously first quarter of this year is down on where it was on that strong first quarter in 2021. So I think overall during the course of 2022, we look at a weakening picture, really reflecting the pressure that's on UK households and how that's likely to impact on the wider housing market. Certainly, if you look at the headline figure rate at the moment, house prices are being reported by the Nationwide and the Halifax, is still strong year-on-year increases. But I suspect that actually, if we're looking at turnover and things like that, that is starting to cool off, and certainly in terms of mortgage approvals and that sort of thing. So a weakening picture certainly in the near term. But as I say, there's a strong pipeline there of potential projects that can go forward. And if the confidence comes back, yes, I would expect a rebound as we get into 23 and 2024 with a return to growth there. Then moving on to the social housing side of things, we include student accommodation within our sort of our breakdown of this sector, and that had been a sort of strong growth area until recently. It fell back quite sharply during the pandemic. Certainly, if we, as I say, that's some of that. I'll circulate these slides, but just to keep the time short, to keep to work to time, I won't say too much about this other than that it's quite interesting that if you look at the number of students that are going to halls of residence, that is a proportion of all, that does seem to be dropping away at the moment. And certainly going forward, what we're anticipating is actually that sector will recover in terms of student accommodation, but it's going to remain below where it was pre-pandemic levels. But it's more the social, proper social housing, to excuse the expression, that sector being taken forward by housing associations and so forth, that we expect to be the main growth area here and driver for sector activity over the next 2 to 3 years, with housing associations now being in a better place to take forward projects and to boost new supply into this sector. Moving on to the industrial and commercial side of things, or private non-residential side. And again, I think a lot comes back to how consumer habits are likely to change. What we saw during the pandemic was an incredible increase in online purchasing, a real grab of market share for internet sales against sort of bricks and mortar retailers. Now that has come back quite a bit since things have opened up. And also, I think perhaps as people have become a bit more price conscious, a bit of hunting around going on, particularly on the grocery side of things. So you can see both from both charts really, with both the green line on the left and the higher line for internet sales on the right, how that's has fallen away over the course of sort of the last sort of 6 to 12 months really, but still remains significantly above where it was pre-pandemic levels. And I think that's one of the interesting things, is I think this is probably it's probably stabilizing now, and it's going to continue to return to growth. So I think there's been a marked shift there in consumer habits, which has accelerated a trend that was already underway, and that's going to have significant implications for both for the retail sector and for industrial construction. On the retail side of things, as you can see from the chart there was already a decline underway there in terms of project starts prior to the pandemic. That was a big slump during 2020 and a partial recovery last year. Really, we don't expect any significant further growth over the forecast period in this area, given the overhang of excess retail space that a lot of high streets and shopping centres face. There's going to be a lack of investment going on there, other than perhaps a bit of remodelling work going on, whether perhaps a repurposing and redesigning shopping centres. The one near us is being redesigned, where actually they're reducing the amount of retail space that's there and converting some of it to other uses. The other perhaps growth areas on the supermarket side of things, where there's a lot of investment, particularly by the deep discounters, the Aldis and Lidls, who have got expansion programs in the UK. One of the sectors that certainly when we looked at it in November, that we were expecting a strong bounce back over the next couple of years was hotel and leisure, in large part because it didn't really come back last year. The hospitality sector was one of the last parts of the UK economy to emerge from lockdown, and had obviously had a whole series of various restrictions that were on the hospitality sector in terms of opening times and when they could open. And our expectation was actually that there was a lot of catching up to go to come back there, as delayed projects could finally move forward, as the sector had a bit more confidence to take projects forward, and an expectation of a return to financial, firstly to rebuild their financial balance sheets, but then be able to have confidence to invest. There's going to be further growth, and I think that's an area where I'm be more cautious going forward, given the real squeeze that's now underway on UK households, due to the sort of it's being referred to the cost of living crisis and inflationary pressures that's squeezing household budgets, and discretionary spending in particular is going to be hard squeezed there. So that's going to really effectively hit the hospitality industry again, perhaps going to mean that capital expansion plans are slower to flow through than they would have been otherwise. One of the other areas, obviously, moving away from look at the other main commercial element, which is offices, that has bounced back actually probably a bit stronger than we anticipated, and likely to during the course of 2022. There's been a number of new build schemes that actually have been moving forward, which, given the uncertainty in the sectors facing in terms of a potential structural shift, is interesting. I think a lot of those have been looking to try and ensure they had sort of sufficient pre-lets before they could move forward. But there has been investment going forward in there. But as I say, a number of potentially delayed new build schemes have been moving onto site in London and elsewhere. So that, as I say, sort of helped lift activity in 2021 and has during the first months of 2022. Longer term, though, I think it's really how people want to use their office space and how much they're going to be using it going forward. If there is a lot more, if remote working does become more established, I think what we're going to see is perhaps more refurbishment work and remodeling work going forward to try and repurpose and redesign existing office space, as firms perhaps downsize the amount of office space they take, but trying to make sure that it's a much more collaborative space, so that when they have got staff in there, they're getting the most out of them in terms of that collaborative element, and when perhaps they're not there, they're getting on with the stuff that doesn't need that collaborative input in the same way. And then within the private housing side, non-residential side, the other element is the industrial building side. Now, again, strong growth, actually real strong growth last year within this sector, a big bounce back, and we expect further strong growth over the next 2 to 3 years. Again, we might be slightly tempering the pace back of growth back in our forthcoming forecast, but that growth is still nevertheless going to be there, very much driven by the demand for logistics space. We see that as being the fastest growing element within the sector, particularly on the back of that growth in internet sales, and therefore the demand for logistics facilities to service customers, either from major distribution hubs or from smaller premises near urban areas or within urban areas, to allow to facilitate that final mile delivery of products to customers. And certainly, I think we've got on the charts there, you can see that the strong growth there in terms of detailed planning approvals that have run significantly ahead of the growth we've already seen so far in terms of project start. So there's a lot of potential there for substantial growth over the forecast period. Interesting looking at where the planning approvals have been over the last sort of last year and the first few months of this year, you can see the prominence of East Midlands, East of England, which have been growth areas and major areas, and also Yorkshire and the Humber, and the northwest and southeast. Those sort of areas, West Midlands is been, there's a lot around industrial areas, but also around our major distribution networks. So we facilitate those large premises that can facilitate the logistics that's required for internet sales and so forth. Whereas areas such as London, it's really not still not a big element of the activity within the capital. Then moving on to public non-residential areas such as education and health, where health, I think, it's got a positive picture going forward. We did see quite a lot of growth during the pandemic. There was obviously the Nightingale Hospital activity boosted activity during the first year, and the government's got a long-term commitment to put a lot more money into the NHS, including capital spending, which has generally been increased, and also they had the election promises of supporting 40, I think they described it as 40 new hospitals, but major sort of elements, additions to the NHS stock, whether it's in terms of a new hospital or extension to existing hospitals. They, as I say, the pipeline is building, but it's not rapid growth yet. And I think that may temper the pace of growth in starts during the current year. If you look at the chart there, in terms of the major projects, you can see the big leap in the latest figures for May. Actually, that's due to not so much the government's NHS program, but actually I think it's a £450 million hospital that's it's got approval in Jersey. So it's kind of there's something in Channel Islands. It's boosting the figures, and actually kind of underlines one of the reasons why when we're doing our forecast analysis, we leave out the really big projects over 100 million from the forecast modelling and data. Obviously they're important in their own right, but I think they can really mask underlying market conditions, given their relative scale to the overall market on a month-by-month basis. So overall, as I said, we were forecasting a steady climb in activity within the health sector during 2022 and 2023. I would just temper the pace of growth during the current year, but I would expect growth to permeate through both into 23 and 2024. I was going to mention the other sector I was going to mention, I haven't actually got a chart for, is education, which is again a positive area and is a growth area going forward. Prior to about 3 or 4 years ago, the biggest and fastest growing element within that, or not biggest, but the fastest growing element with that was universities or major investment programs going on there. I think given the squeeze on university budgets and funding uncertainty into student numbers, I'm more cautious about that going forward. Plus, obviously, a lot of investment has already gone on in those areas in new facilities. We do expect education to be a growth area though over the forecast period, and I would really looking to increase investment in new school premises and an extension to schools, really to accommodate what has been a rise in pupil numbers in this sort of the secondary school age group, and that's sort of going to help drive growth in that area over the next couple of years. And then very quickly, just to touch on the civil engineering side, because I think that's interesting, because it's again, it's been one of the areas that we're anticipating to be a growth area over the forecast period. The government's made a lot of comment and commitment to increasing investment to drive UK productivity, particularly sort of post-Brexit and trying to get the productivity gains coming forward. We've got some big high-profile projects that are coming forward, like HS2, but certainly if you look at the charts there, in terms of underlying projects, not been a big increase. Underlying is the blue bars there, not really seeing a big increase in activity there, which is somewhat disappointing. and I think it's going to temper the pace of overall construction growth over the next 2 to 3 years. So this is what we were forecasting in November. So we had a bit of quite a strong bounce back from the pandemic disruption in terms of the value of underlying project starts in 2021, and we were anticipating further growth over this year and next. Certainly, I think that general pattern is still going to play out, but I do expect actually the pace of growth, given the deterioration in the economic picture that we're currently facing, it's going to be a much flatter picture during the course of 2022, and then hopefully returning to growth, or certainly predicting return to growth during 2023 and 2024. So hopefully that gives you an overall view. I think I'll stop there and then open it up to questions.
My host says it's stopped my video.
Okay, I'll stop my video. Let's see if I can get this to.
I think that means you've got to stop sharing.
Oh, there it is. Yep, got it at the top. How's that?
Super, that's clear.
Brilliant. Okay.
No, my host, Abraham, you've stopped my video. That might be a good thing. Ah, right. We're good to go.
On screen.
We're good to go. Right. Let me just have a look and see what the question situation is like. So don't forget, folks, if you've got any questions or comments for Alan, please go to Slido, hashtag LM170622, place them there. I can't see any questions at the moment.
Okay.
But what we thought we might do is bring some people online and just to get the ball rolling. I know, Howard, we were chatting while you were talking, and you've got a couple of points, haven't you?
Yeah, sure.
Yeah, I've got a couple. I know that in a city near me, I'm not going to give anything away, that contractors, and this is competing contractors with different potential projects, are now meeting quite regularly to discuss the issues of skills and availability of both labour and materials. This is because there's not enough labour or skills to go around for them to complete projects. And it is led in one project to a delay to start for 3 months, and then a further delay for another 3 months, whilst they actually get the things in place. So that's a sort of 6-month delay, during which time they've all seen an increase in costs.
Yeah.
Do you see this as a continuing trend? Because every sector is suffering from labour problems, and the skills, can't be put on people overnight, even if you've got people to actually put them on.
I don't think it's going to go away in a very quickly at all. I think, and I hadn't really touched on when I was going through the presentation the skills side of things and the labour availability side of things, but not because it wasn't a problem, but because I think the material impact has been perhaps even more immediate impact, disruption, and certainly the sort of the comment that we've had back is that actually anecdotally is that people have had to delay, as you say, delay projects to look at the materials availability, just to work around that. And when they are ready to go ahead, then the labour's moved on. They can't get the labour because the labour they've moved up, it's gone on to the next
this is the problem they've got. In other words, if we start our project, we'll tie up labour that you need to start your project. What do we do?
Yeah.
And you can't breed people overnight to become people that you can then put skills on. So do you see this as a sort of problem that's going to last for a few years? Is it something the sector's going to have to live with? Because you can approve projects, but that might mean you can't actually deliver them. And a classic example from another client I've got is, they're into hospitals, and the government is committed to building 40 plus hospitals by 2030. And his view is they'll be lucky if they're able to build 6 or 7.
Yeah, no, I do think I think it's going to be a long-term issue. I think the materials side of things, I think, will ease potentially, certainly in terms of cost. Hope if certainly if energy costs start to at least stabilize, and then it'll be sort of it may be at a higher level, but at least hopefully we won't have the rapid increase and escalation in costs that we've been facing of late. But I think the materials, so the labour issue, I can't see that being resolved very quickly. As you say, it's we already had a problem prior to the pandemic and to Brexit as well. And both of those factors have exacerbated a situation that was already there. So in terms of, training is going to be key, recruitment is going to be key, but the workforce itself has shrunk. So we're all fishing in a smaller pond, so to speak.
Okay, I'll pass back, but we do have one question
yes, we do.
From Richard, so I'll hand back to you then.
We've got a first question, Alan. So Richard, one of our good friends, currently heading our building quality and safety group in the Southwest, says that Michael Gove said they want to spend more on infrastructure but cannot afford it. What are the risks, in your opinion, that the government may raid the capital spending budget?
Yes, we've seen that before. It's interesting to know whether, yes, it's interesting in Michael Gove's comment. Is he aiming that at us, or is he aiming that at the Treasury and his other cabinet colleagues? That's the interesting thing.
Yeah, it could be a shot across the bow, couldn't it?
It is, yeah. So preemptive move. I mean, because clearly, the government is committed to this levelling up agenda, and actually, if you're going to deliver that in the longer term, and you're going to deliver improving UK productivity in the longer term, it's got to be through capital investment. And it comes back to the previous comment about questions about labour availability and things like that. Actually, you've got to have the efficiency gains there and the productivity gains to try and ease those pressures, and actually to lift living standards generally. So yes, I think there is a need for it. There is going to be a temptation for them to raid the budget to give immediate subsidies and support to households and others. And I suspect the government track record on that area is not good, I have to say. But
I think, though, just to keep balance here, I think we ought to say that I don't think any government that's gone through the pandemic and now this Russian-Ukrainian war can be held totally responsible for the situation we're in. This is a global situation.
It is, absolutely, and I think it's important that, as I say, when I say government record isn't good on this one, I don't mean this government. I mean over the last sort of 50 years.
I know. No, I'm just trying to sort of put a balanced view on this.
Absolutely. I think it's a really big challenge they've got. That we've all got, really. There is a lot of disruption, and it's one of those things. Just as we were getting over the pandemic,
I know,
we're into the next problem.
So, and if you put Brexit before that, I don't think I've ever encountered anything like this in business terms. Well, in general terms, in my life. And the one thing that business doesn't like is uncertainty, and that's what we've had, one thing after the other, haven't we?
We have.
So I think we can, as a sector, or we should, as a sector, give ourselves a bit of a pat on the back that actually we're coming through this with relatively flying colours, relatively speaking.
Yeah,
Alan.
I do. I think that's true. And I think the other thing that would be great if the government could do is, coming back to that capital spending side, is government isn't the only one that where area that capital spending is important. If they can, any support or encouragement they can give to other parts of the economy to invest as well, for businesses to invest, again, that's something that the industry, UK construction, would benefit from as well, both directly and indirectly.
Yeah. Okay. So is there anyone else on the call that would like to ask a question, or maybe come online and have a chat? We're Howard's got his hand up, so let's bring Howard in again.
Yeah. Alan, there are always, from the economics point of view, what you call recessionary lags that vary from sector to sector. So, for instance, the retail sector normally falls, within the first weeks or months of a recession. Where does the construction sector stand in that? Because normally lots of people talk about we have a good order book going into the next 2 years, but coming back to labour shortages, capital cost shortages, when do you think the lag will actually impact? You know, are we going to feel this in the next 18 months, 2 years, or further down the line than that?
Well, certainly, I think in terms of value of work starting on site, as I say, I think it's going to be relatively near term, and I think a lot of that's to do with the point you made about actually from struggling to get projects onto site. We're an investment. Basically, we are investment. Construction is investment by and large. I think, and that's why I think we're so important for the UK economy, because it's, you know, if you're going to have long-term prosperity and improvement in living standards, you've got to make that have that investment to deliver that. But I think that the danger is with a weakened economy that actually, that then impacts on investment spending and therefore construction spending. You mentioned the retail sector. That's why we've got a bearish forecast for retail construction. So I think effectively, what's going to be key, as I say, is getting some of that public sector investment in the near term coming forward. I think that will help to lift things if they can deliver there, and to help to sort of build confidence. So yeah, I think we're going, in terms of recovery, I think we're going to lag behind a little in some respects from the rest of the economy in that sense. As I say, we saw a bit of a rebound from the initial pandemic last year. So that was quite a strong bounce back that you saw in 2021. I think the problems in Ukraine is going to temper the pace of growth really subsequently. But yeah, I think we're going to lag a little bit behind given the squeeze on companies and household budgets.
I see that we've sent out a Treasury representative to start talking about the rebuilding of Ukraine, which obviously creates great opportunities. But I assume that funding would come from the World Bank. Is that right?
I'm not up to speed on that one, but yeah, I think it'll be, as you say, potentially huge investment there if we can get the funding for it. Maybe we should put sort of some tariffs on Russian oil and gas. That could help fund it.
Yeah.
Right. I'm just looking on Slido, Howard. I don't think we have any further questions. And we don't seem to have any more questions from the floor. So I think what I'll do, Alan, is thank you so much for your time. If we could have a copy of the presentation, what we tend to do now is we tend to send it out to our members and database. And we find that actually more people now view it in their own time than they do live. I think we've all got used to that, haven't we? Reading material when it suits us rather than at a given time. So if we could have permission to use that would be most helpful.
I'm quite happy to
and
do
then
that.
We'll issue that, I think, in the July newsletter for our members and supporters. That would be good.
Okay,
that would be good. So Abraham, have we got details of next week yet, or are we still struggling? Let me see what comes up on the slide. I know we were having problems getting the information. Sorry, Abraham.
We don't have details for next week.
No, I didn't think we did. Okay, we that's work in progress then. So getting back to today, in that case, if you need a CPD certificate, please go to My Pro Pass. That will create your free account, and then you get your certificate there all in one place. So it just leaves me now to once again thank you, Alan. Thank you to Howard and to Abraham of Leaders Meets, and thank you to everyone else for tuning in. We'll see you next week. Or I won't. Yep. Howard's hosting next week because my son's getting married a week on Saturday, so I shall be preparing for that. So I wish you well. Thank you.
Okay.
Bye-bye now.
Thank you.
Thank you.
Bye. Bye. Okay. And
thank you, Alan, for your time.
that's right. No problem.